going to be a personal bond is a legal document. Okay, so it's a legal document. It's like stock and the stock market. So as a document, there is a document that you choose, the company needs to go through a process to issue this funds for the government. It doesn't matter. Okay, so that piece of the contract cannot change easily. So when they start, when they want to raise money, they decide how much. The par value of that bond shows that amount, $100,000 a year. So that is the amount they want to have. So they issue the bond to receive some $100,000. They are issuing the bond, meaning that they are borrowing, right? So that's why you have the cash that goes up. Asset now, they have no asset. And then bonds payable, which is a liability, goes up as well. And this is a simple situation. And you see here, we have the par value. We also have the stated interest rate, 8%. That stated interest rate is the interest rate that is going to be paid throughout the life of that bond. There is a difference between when we have bonds and when we have like something like mortgage or we borrow in this type of way. So when we have mortgage, usually what we do is that we have to take part of the principal back as well on top of the interest. So little by little we pay a portion of that principal as well. So the interest calculation will be different each time that we pay, because each time that we pay part of the principal and part of the interest. My very simple example is that you, for example, want to buy a home. You are going to apply for a mortgage. You have certain amount on hand, like let's say you are going to buy a $200,000 home, which like anything or something, and then in exchange you have like only just 50,000, and then the remaining 150,000 you are going to apply for a mortgage. So you are going to borrow. And the difference between mortgage and bond, the main here is that mortgage is going to secure for the property behind it, right? So the bond comes in and evaluates your home that you're purchasing, and that home secures the mortgage. It means that if you have a default to pay, then the bank can own that home. But for the bond, that is not the same. The bond, the face value of the bond is the amount that was borrowed, and that is going to be paid back at the end as well. For the mortgage, if you apply for, like, let's say, 30-year mortgage, then for that $150,000, the bank will give you a schedule depending on the schedule of interest. They're going to say, okay, let's say each month you're going to pay $2,000 to the bank, right? That $2,000 was small. The first payment that you pay has the biggest portion. Interest will be a little bit lower. The third one's a little lower. As we get close to the 30th year, the year 30, then mostly is principal. The interest is very, very good. Okay? So that's how we deal with mortgage. But here, when we have the bond, interest will remain the same. How much interest we're going to pay? That 8% here, 8%, which is a yearly rate, similar to or anything else that you have. Whenever you see a rate, an interest rate, that is going to be a yearly rate. And depending on how many times they're going to pay,
Yes, I'm in class.
because they're going to pay interest twice. So one time they're going to pay at the end of June and then one time at the end of December. So they're going to pay twice. And it's a 2-year. No, it means once. So it means that at the end of the year 2, they're going to pay this $100,000 back. And during the
Financial accounting.
December and June, they're going to pay at 8% for that portion of the time. So it's going to be 8% multiplied by 100,000 divided by 2 because it's 2 times payment, right? So you have to divide it by 2. 4,000 one time, 4,000 times the other.
Financial
So
accounting.
this is our first journal entry. And at par, when we say at par, this is a deal that we had with one which we didn't have in the last week. Then it says at par, it means that in this situation, the interest rate that you see there at 8%, the market has the same rate, 8%. So that can be different. So pay attention to that. Now it's at par, when you issue the note at par,
Where y'all from?
You have cash goes up, account payable also goes up to show that you are going to have some liabilities in the future. And then when it comes to the calculation of the interest, you see that here they're going to pay interest 2 times a year, and it's a 2 year, so they're going to pay a total 4 times of their interest, 4 times. But those 4 times are going to be exactly similar, exactly the same. So each time they're going to pay $4,000 of interest, the interest expense goes up and cash goes up. Okay? So cash goes down. So the expense goes up because they're paying that expense, that $4,000 how do they pay by cash. Okay, so that's what that asset is going down. So how do we calculate it? Depending on what is going on. In here, because the focus is on what is the premium, what is discount, what is at par, we don't see that extra calculation. And every single example that we have is from the beginning of the year. So this is similar to what you might have known. If the bond wasn't sold at the beginning of the year, then we have partial interest that we a specific month until the first payment. Right? So usually, if that's the case, they're going to have partial payment of interest for the first and very last month. But here, you don't have that issue. So that 4,000, that specific journal entry that you see there is going to be repeated 4 times until you find to pay back the bond. So how do you pay back the bond? We're going to just show that payment. And the Secretary of 2028, that is issued, once was issued, and then it was paid back.
Financial accounting.
One payable, pay attention to this. One payable is always going to be what we see as the face value. Okay? So never ever you have anything else. One payable is always equal to that. So the liability is going to be whatever is mentioned on the bottom. So that is what we see here, and the cash was paid, we're done with that. And this was at par. Okay? So at par was easy, we shoot, we have some interest, and then it comes to the payment, we pay back. Okay? So that's the first situation. Let's go over an example. On January 1st, Boston Enterprises issues bonds that have 400,000 already maturing 20 years and pay 9% interest semi-annually on June 30th and December 31st. The bonds are sold at par, so you always need to pay attention. If it says at par, meaning that when we say at par, it means that the interest rate that is received on the bond is equal to the market rate. So whatever the market is paying is the same as what is mentioned, 9% is the same. 9% of the so you're fine. That's fine. So means that when they issue the bond, they are going to collect the full amount of 2,400, and that par value is 3,400, and each time we're calculating the interest, that is going to be every 6 months, right? So every 6 months and for 20 years. So for 20 years, they're going to receive this. They're going to pay this interest. That annual rate is 9%, And so because they're paying twice a year, so you're going to divide it by two. That's why here we have 1.5%, 9% divided by two. Okay, and then we're going to have a cash payment of interest of 152,000 each time that they pay interest. How many times they're going to pay? 40 times. It's 20 years, and each year they're going to pay less. So 40 times they're going to pay 153,000 because we call that committed 400. And then that is the interest. And now it comes to the reporting of those 100. First drawing, issuance of the fund. You report it on value of the fund. Payable goes up and our cash goes up for the same value because here we have the at par that system situation. So cash goes up for 200,400, and then bonds payable also goes up for like 300,400. And then the second goal is to report the first interest payment. First, the second, and going to the 40th interest payment will be the same because we deal with the bond and the interest is going to be the calculation is based on the full face value. It's not like mortgage. So we're going to have the one interest expense. So this is an expense, interest expense, 153,000. And then we're going to have the cash payment, 153,000. The second one will be the same. We're going to have the same amount. Okay? And we're going to continue doing this until the maturity of the bond, and then at the time of the maturity, then the bond will be paid back. Meaning that 2,400 will be paid back.
That's a 2-hour class. This class for 2 hours. I get out at 3:30.
Yes. So that you know that you're paid, I know that you're paid at the core situation, so I move to this. So now we just write the journal and this is going to be a core situation. So I'm going to write the journal and because it's simple and easy, but I want to make sure that you know how to calculate the interest and cost, and also write the first and last one that is issue and then it's paid. So first, journal entry is to report the issuance. So you are receiving more cash, and then you have one payable. The royalty account. So cash goes up, the royalty account goes up as well for the first one. So the second one will be the calculation of the interest. And for calculation of interest, we have 9%, and we have the semi-annual, so you know that it's twice a year. So 9 divided by 2 will be 4.5, and multiplied by that par value. calculate the interest. Par value is 3,400,000. So you have that, you have the interest rate, you can calculate the interest expense. And we show that the interest expense is paid is proof of cash payment.
Done.
So for this one, what we do is that the bond is issued because that par is simple. Collection is for the total par value of the bond. So we have the cash that goes up for 2,400. And then also we're going to have the bond payable that goes up for 2,400. So it's a label account and the issue account, we have a label.
Okay, so I have a question. I have that, but I just like put them in the like I put the
Yeah.
bond on top and the cash on bottom. Is that still correct or no? Okay.
No, that when you have that journal,
Yeah.
you have to have the debit first and then
The credit.
so debit first, then credit, right? So
Right.
debit, credit. Credit cannot come first,
Right.
right?
Okay.
So you have to have that debit.
All right.
Okay?
Thank you. All right.
Sure. And that is our first journal statement. We show that when we have the debit and cash, that debit and cash, that on the left side shows that we have more cash. Okay? And so that is why we have it first. And then the low change always has the credit balance at the positive. So when it goes up, we have the credit. Then to report the government entry for the interest, we need to do some calculations, and that calculation is to multiply that 400,000 by 9%
Got that one.
and divided by 2 because it is twice in their payment. So we're going to have 153,000 and we're going to say one interest expense, and that amount is for 100. And the second program for the interest, which is going to be, and the dates are important. You see that here, my date is on June, and then June, and then the other one will be on December. And we're going to have this for 8 times, right? It's a 4-year note, a 4-year bond. Each time you're going to pay the 150,000 each time. So maturity. So we're not going to repeat this, but we know that this makes it going to be repeated additional 3 times, right? So we're going to have a total of 8 children before we're done with that. And then last journal entry will be the repayment of that one. So the payment of the bond payable always going to be the par value, and cash is going to be and this was a simple situation. Okay, so now we move to more complicated situation. When there is a senior So anytime you can trade that, you can issue that today and then you can sell it next month, right? So depending on the situation. Yes.
Why did you put that to the
Business loan?
Is there a bond when
Business loan.
Yeah.
The thing is, I think this is something that they do when loan comes into the picture. Usually there are more security involved, like so when the bank wants to use the business and they're going to go over a lot of information regarding the business doing and how much is their income and how they're going to make tax or not. But this is very simple. There are necessary to any investors or possibly that as many investors as possible in the time. So when the bond is issued, that means that the government, like you hear before that California is issuing some bond, and we don't have any. So when they do that, it means that they want to, let's say, heal the bridge, heal the bridge. They want to see something. They don't have the fund. How do they raise it? They're going to sell the fund, and in the future they're going to pay it out. That is a very good possible way to raise some money. It's a bigger corporation and also the government. And when it comes to funds, it can be a lot of investors. It's not just only one investor.
I was gonna say, like, also the bond, like, you have like a semi-annual
Interest
expense, which means like the person like the interest aggregating a certain amount of like consistent cash flow that way.
That's a very vast inquiry to investors want to invest. So now let's move to the more difficult situation. Then what is issued at this time? So by now we learned that okay, that's 100,000 par value. This is a simple question, a simple example. And the company decides to issue bonds with $100,000 par value. It means that they want to collect 100,000. That 100,000 is not just only one investor. It can be as many as depending on each value of each fund. It's like more than stock. So many investors can buy those funds. Okay, so like that. And then in here it says the bond issued at 96.4%. Why is that? Why we have this piece of information here? Because as you see there, the interest rate of the bond was 8%. At the time that we issued the bond, interest rate was 8%. Today's rate of the market, which fluctuates all the time, shows. So if the today's market rate is 10% and I want to invest, I'm an investor. I want to or buy that fund. Right? Why should I do that? Like, if I can earn 10% interest on the market, then I'm not going to go and buy that fund. So the companies or the government is vehicle to do become and sell those bonds and if you collect some money, they offer some discount. Okay, depending on that 2%. You're going to calculate it, the calculation of how much is going to be collected is going to be given always. That 96.4% tells us that they're going to issue the bond because their stated rate is lower than the market rate because that make sure that the investors are going to be interested to invest. They're going to say, okay, you pay us that 100,000, a little less. We're going to give you a discount. Okay, so that discount is calculated based on certain calculation. We don't need to calculate, but that 96.4% tells me that when they are going to sell the bond, they're going to collect that interest that they are paying upfront. Okay, they're going to say, okay, you're not paying interest of 10%, you're paying 8%, but you're going to calculate that portion of the interest. So interest calculation will be based on that 100. No matter if it's FR or discount or premium that you're going to go after this, this is going to be what you use to calculate your interest. One face value or par value. Okay? That par value will be used, and that what is going to be used to calculate the interest? The stated rate. You don't care about market rate. The stated rate will be used to calculate the interest. 80% of 100,000 and pay here, they're going to pay that total of interest. And then in here, again, they're going to pay twice a year, so that percentage time, okay? And then the maturity date is in 2 years. So 2 years, they're going to pay that back. So how much are they going to pay? 100,000. So they collected only 96,400, but they're going to pay more. And that's because they didn't pay the rate as good as the market. They didn't. As a result, they're going to cover it back. So when that's the case, when they issue the bonds, the donor entry that you're writing is not going to be as simple as the par situation as we just saw. Now we are going to have the par value of the bond, 100,000. That doesn't change. Par value is par value, and it's the face value of the bond, and that does not change. And so anytime that we write the donor entry, that bond payable, pay attention to this. That bond payable part will be the par value, nothing else. Okay? It will be $100,000 no matter what. That will be that's coming from our par value. So bond payable part will remain the same, par value. But how much did they collect? Just 96%, 96.4%. So cash profit was only 96,400. The remaining, as I mentioned, in this example will be 3,600, which is going to go up to this. Okay? So we have a discount. Discount is our journal entry when we have the one payable because the cash that was, we reported previously was 100,000. Here it's not saying it's 96,400. So we are not balanced. We need to balance this out. So that's why we need to add a discount on one for the difference of the two. And that discount on the one is like the loss, always going to be on the left side when we report it first. And if you want to reduce that value, then you are going to do a credit. So what is the discount on the bond? It's a contra as a contra liability account. So because our liability has a when we have a discount, we will have a debit balance. It's a contra liability. I would see just long-term loyalty and that one payable. But it's not a car situation. So my asset went up by 96,400. And my liability cannot go up by 100. Right? Then another balance. Right? Asset is equal to the total liabilities plus owner's equity. Owner's equity remains unchanged. So asset went up by 96,400. My liability cannot go up. Need to have that contract liability account and then it's a contract. You see that less discount on bond payable, which is 2,600. Now the carrying value on the bond is equal to what actually was received. The total asset now is equal to the total. So this is what we have. And as a result of all this, we're going to do our calculation a little bit of, there's a little bit of difference here between this and then we have the interest calculation in our par value, at par value, when the market value was equal to the stated rate. Okay? So how is different? Because in here, if you calculate the total amount of interest, it's going to be 4 payments. And that 4 payments, right, it was 8%, and twice a year, it's going to be 4,000 each time. So the total payment will be how much? It will be 16,000, right? They're going to pay that 4 times, and that 4 times each one, 4,000 is going to be 16,000. And how do you get that 4,000? That is simple. Par value multiplied by the stated rate, multiplied by the number of times that this is paid. Twice a year, that is going to be like. So it's showing you 16. Okay, that's why you have it like that. And then so that $60,000 of total interest is happening. In addition to that, we're going to add the discount plus our discount of 2,600. That is going to be the total interest expense. Okay? So the discount indirectly will become part of the total interest expense. We're not paying that in the form of interest, but we're paying it anyways. And we're going to say it's part of that interest expense because that is the reason we have that discount is because of the lower interest rate that we offer. Okay? So that discount stays there, and then each time that we write journal entry for that, we are going to have the interest expense. And so in here, we got the total 19,600, we divide it by 4. So each time we have to record 4,900 interest expense. 4,900. And that 4,000 will remain the same. The cash that's paying is based on that 8% and that half of the year. So that 4,000 will remain. This is similar to what we did in our situation. But the 900 is the amortization of that discount. So we have the discount of 3,600. We're going to divide it for that 4 payments of interest divided by 4 will equal to what? 900, right? So each time we're going to reduce portion of that discount. So basically what we do by doing this, by doing this journal entry, we're reducing this each time until our carrying value is equal to our bond payable, is equal to face value. Okay? So that's the carrying value of $96,400. And at the end, they're going to pay this back, 100. So we don't want to have any discount remaining. As a result of that, each time you're reducing that discount and you're putting it as an expense to our income statement. We remove it from our balance sheet, we add it to our income statement. Each time, how much? Depending on how many times you're paying. So in here, it's simple because you're in this specific chapter, we're just amortizing straight line. This is very similar to what we learned as depreciation, straight line depreciation. So depending on the useful life, right now the useful life or the life of that one is 10 years. 4 payments, yeah. So years and 4 payments. That 4 payments gives us the idea of how to amortize that. So each time we're reducing that, you see that when we recorded that discount in our previous slide, that's the debit. Remember, I said it's a actual liability. So whenever it's credit, it means that that is going down. Okay, so it's a counter liability account. Similar to ask the positive value. Okay, so next, this is what we see as amortization table. This is what we have. Each time we are reducing the value of that 900, 900, until that discount is being paid. As a result of that, our carrying value goes up by 900, by 900, until we get to this as what we have a discount. So we're ready to prepare that one, right? So that 100 is going to be calculated based on that. And then let's go over another example here before I give you an example to work on. It says that total issues with of 180,000 January 2021. The bond annual contract rate is 8%. So we have 8% and interest payment is semi-annual, and that is going to be in June and December. And the bond mature in 3 years. So 2 year bonds. How many times are going to pay years? Right? So the annual market does not tell you that it's discount right away, you know that's the discount rate. Because market rate is greater than the state rate. Okay, so you know that the discount. If they won't offer a discount, then you invest and then buy their bonds, right? So that's one. And then they sold the bonds for 170,862. So this will be given either as a percentage, if it's a percentage, you need to multiply that percentage by the face value, or here it's calculated already. We calculated that for the one that percentage was just gonna add. So the first question is, what is the amount of the discount on this bond issuance? So you know that the discount is what? The difference between the par value, right? And whatever you collected. The discount is equal to that. So 180 minus 170 is 49,138. And here we have the 3 years one. So as you mentioned, it's going to be 6 times of low interest payment. So the next question is that how much total bond interest is that will be recognized over the life of this bond. So how much total interest? Okay, so including that discount. Thank you. So that total interest will be calculated based on the total 180,000. So anytime that we calculate interest, we use a par value. We don't care about how much was collected. But we care is this par value about this. Okay. So 180,000 multiplied by 4%. Where we get 4% from? Is the interest rate on bond 8% divided by 2. So do we care about that 10%? No. That 8% divided by 2 divided 1, because that is the 1. So 180,000 multiplied by 4%, each time they're receiving, they're paying $7,400 of interest. So for the total of 6, right? 6 multiplied that by the 7,400 will be 43,200. And we have that discount. You're going to add that discount as well. So that discount will come down from here. We already calculated that. So the total interest recognized over the life of the bond will be equal to 52,300. Okay, so the benefit will go interest. And when it comes to the journal entry, we have to be careful with that. We have to know that how much amortization we're doing. And here, the reason that we have this chart to make sure that we know what's going on, why we amortize and why we are going to show each time as a portion of interest expense. Because, as I mentioned before, we started with 9,138. So as a result, our less. This is what we show in our balance sheet, which is the difference between 180 and this. So 180 minus 9,138 will be equal to 170,860. So each time, 6 times, I'm going to reduce the value of this 6 times, okay? And then finally I get to 0. In here, when I do that, the value of this goes up, until I get 180,000 of registered display platform. So how do we do it? We're going to have that similar to what we did before. We're going to have that amount, 1,523. Is that 1,522 there? How do we calculate it? Is that 1,138 divided by the number of the time that you're paying interest to 6. So this is going to be divided by 6 to get that 1,522. Okay, so now each time I'm going to reduce this by 1,522. Each time 1,522. So each time my carrying value goes up by 1,522. Why? Because my carrying value is the face value minus the discount. So each time, because my discount is lower than until I get to that 180. And this calculation shows that each time I'm going to report the $1,532 as partial interest expense. So if I wanted to write the donor entry for this, then the donor entry would be what? The first donor entry would be one. First cash is received. How much?
1,007.
Yes, 1,862. And then cash, then on as a result, we have a one payable. But that one payable is equal to what? One payable. One payable is equal to 180,000. Correct? Right? Yes, discount would be how much? 9,000, the difference of it. So you don't necessarily use numbers, but that order is because one payable goes up, as I mentioned, always by the face value of the month, so 180. And then here we have cash. That cash goes up by 170 and 860, and that was here. And the difference between these two was going to be our discount and one payable of the 9,130. Okay, so this is our first donor. And the second donor would be the payment of the interest, right? So those payments of the interest is going to be some interest expense on the debit side, but that interest expense we don't have it. You have to calculate it. Each time, partial is the interest payment, which is cash, right? That cash is equal to this 1,500. Will be the total of the cash and paying by 7,200. And then also the discount that is going to be amortized. And that discount will be how much? 1,532 each time. So the total of these two will be our interest expense. Okay, that's how we have to do interest expense. Any questions? If you don't have any questions, then let's do practice with this together. So before I move to and in this question, the emphasis is on writing the journal entry for this type of question. So need to write the journal entries. So start writing your journal entries. I'm going to go over it. And if you keep working after doing this, then you can have a little break and then. So the first journal entry is always write how much money was actually received, and one payable will always go up by the face value, so the difference between the receipt, you know that, right? So this question for the first part, what we're going to do is that we're going to show the cash that is received, and we know that the cash received was less than the fund value because it's a discount situation. And for that reason, the cash, the amount of cash is 186,544, and the difference would be a discount that is offered, 13,466, and the total of those two will be equal for value. So the one total is up for the total of the two. And then the first interest payment is the first interest that you're paying. Is going to be the combination of that 13,466, which is going to be amortized over ADP, and how you calculate it. If you don't have it, you have to divide this 13,466 by how many times? By 6 times. Yes, divide it by 6 to get that. And so as a result, we're gonna reduce that value of that discount each time by 1,650. So how we get this, we're gonna divide this by 6. Okay. One is the 14. 40. Yes, 40. Divided by 8 to get that 1,682. It is not even. This is given as a simple, but it usually comes. So the one expense would be for the total of this two. So you have to calculate your interest and also the discount calculation first to be able to calculate the one expense. And so one expense will be 7,683, a similar situation for every single time that they're paying those funds. So now it's going to be a December payment. Beforehand was and then the last journal entry is to record no more recording. So next time, it means that when you record this journal entry 8 times, so 1, 2, 6 more times, then our discount will be over, right? So it's 0 now. And so the journal entry will be what? Will be, yes, the same as what we had before. So the total goes down, debit, and cash goes down, debit. How much? For that. Okay, so that last journal entry will be the same as far as discount and also when we learn about premium. All the same, the last one. So that was it, and then so next one, I am going to go over this example. Drop species 5% and for PTO for drop species 5% 2-year bond from December 31st with a par value of 200,000 and semi-annual interest rate. Use a statement by the amortization table. So basically what we're doing is that we know that the bond was issued at a discount and that total value of 180,000. So what we do is that we're going to get that unamortized part of it and we're going to divide this by 4 because it's 2 years and 2 years and it's going to be 2 payments, 2 divided by 2, so divided by 4. And that is going to be what we have as the each time we're going to have 2,000. And for that, we have the total cash that was received of 180,000 based on. And so the discount will be the difference, and then the one payable will be over the face value of the fund for that. That one payable will not be anymore. So that's, and then for the donor, for the interest, here we have 5%, 5 divided by 2 is 2.5, so that's for 4,000. And then the expense will be the total of this and what the average for the right? So each time we're going to have the same exact form until we're done. Okay? This is going to be repeated 4 times. Because here's and then after 4 times, you see that 3,000, 3,000, 3,000, 3,000. So now we are at this point of one amount that's real value, and then from the discount, and one has a real value, and then carrying value as a result of the face value. So because now we are at this point, it means that in our balance sheet, we just see the bond payable of 200,000. We can remove it by just paying that cash. So next is payment. Any question on this? Next is bond payable, 200,000, cash, 200,000. And the last one, that we mentioned, going to be the same form and put down the and now we can have a 9-10 minutes break and
Mine, boy. Get a little break and shit. Boy, this class is 2 fucking hours. So y'all know what I'm finna go do. Give me a fucking snack real quick from the little cafeteria area, and they ain't even rejuvenate, wake my game up. I'm falling asleep in there and shit. Nigga, I be getting there. That shit is very informative. Don't get me wrong. Financial accounting is very informative. Learning how to make bank statements, income statements, know how to know how to draft a company's inventory, expenses on inventory, all the company's expenses, insurance policies. Like it's very informative, but this class is just it be fucking boring, bro. This shit be boring. I need the knowledge, but She's single. You want to go get some food or something. I didn't ask her yet. I'm going to after class though. Cause I have to wait to make sure she came to class, which she did. And so now I have to shoot my shot. Looking rough and tough like this. So I'm still talking to her. I asked her what's up, like, you know what I mean? We've been in the same class for this whole semester. Every day, I smile at you, you smile at me, you smile at me, I smile at you. You feel me? Miranda, I think that's her name. I don't know. I'll be like, but yeah, though, you single? That's cool. You ever? Oh, okay, well, I'm interested in taking you out today. Oh, I should have said, hold the door. Should have been here, so I ain't gotta walk all the way around. Let me see what's up with her, though. I'm gonna ask her, though. Like, what's up with you? You single? You looking for a man with a plan? You looking for a man? Oh, he's famous. He getting blood drive today. I ain't done none of my blood. My blood is sacred. Thank you, my good sir. I didn't hear y'all put that. We walking way too close to it. Oh, you walking around. There she goes right there.
You have it? Find out. One. Yeah, for the January. No, this one is just for the so it's just 100,000. And it's going to the interest, so 100,000 times 0.07, times 4 divided by 60, so it's going to be
yeah, so it's gonna be 100,000 and times 0.07. So this is for one, and then multiplied by four, and then this is divided by two. So there is an extra because it's an add. Then it's level six. But at the same time,
This is your discount. This should be different. This is not
oh, this is the discount, and not level six.
no, this is not the discount. This is the interest payment, right? This is the interest payment.
Okay, discount. So then it's 4,003 divided by this number.
Correct. That is correct. These are
Yeah,
correct.
this one is
Yes.
divided by. So
But
it's not.
this one, it is going to be 3,500.
Yeah, I got it. It's over here. So now I pay.
This is correct. So,
Expense.
no, this has to be one.
Interest expense.
The total of the two, and then this one, however.
It's the same. This one is the same. June 30.
Oh yeah, yeah. So it's just a
And
payment.
on the end it's bond payable. On the top is election.
Good.
Okay. Now I was thinking.
Right. And then
Well, I'm trying to let's see. We gotta divide this. We gotta divide 7. And twice 30 days. Oh yeah, that's easy.
okay, are you
Done.
ready? Anyone wants to share their work? No?
No. Super no.
Not yet?
Not ever.
Yes. Yeah, what's your
Perfect.
Okay, so for the last practice that we have in this area, we're gonna have that unamortized discount, and how we get it is going to be the difference between what we have as the stated value and our carrying value. And so we're gonna have this 4,048, and that is the result of 100,000 minus 95,952. And we're gonna amortize it. This time we're gonna amortize it over 4 years, and then we have semi-annual, so it's going to be 8 times. So 4,048 divided by 8 is going to be 506. And each time we're going to reduce that value by 506. So it means that each time that I amortize it, it will be reduced by 506, 506, 506, 506, 506, until then it's 0. Okay? The same thing happened to the carrying value, because carrying value is the total value, par value of the bond minus the discount. So 100,000 minus 4,048 was 95,952. Now our carrying value goes up each time because my unamortized discount part becomes smaller and smaller. So that is going to each time goes up by, that goes up by 506, 506, 506, 506, and I'm going to get to 100,000. Okay? So as we have this, then you're ready to write our journal entries. And the journal entries was for preparation of journal entries for any question on this part? Is that clear? So for the journal entries, we're going to first record the journal entry to show that one in here, if you didn't have a spot to record the one, um, it was just only a, yeah, January 1st. No, you didn't have the spot for January 1st. No, no. So you have the spot for issuing the bond. When the bond was issued, then as a result, the cash that went up was 95,952, and we had a discount, debit discount of 4,048, and credit our bond payable for 100,000, always 100,000. And so next, we're gonna have that journal entry to, oh, so I have the issuance of the bond, so you know. This is going to be what we issue. We didn't have the spot for this, so we should ignore it, just to know, okay, this is a practice. So bond payable goes, when we have a credit for payable,
Thank you.
goes up, right? Payable goes up by 100,000, and then cash and the discount. And so next,
Where you from?
we're going to calculate, we already calculated the unamortized discount, but we're going to calculate the actual interest payment, 7% and 6 times and 2 times a year. So that is going to equal 3,500. So for the first year, we're going to have 3,500 of interest expense. How do we do it? $100,000 multiplied by 7% divided by 2. That is 3,500. And then we have the discount amortization of 506, and the total of the two will be $4,006, which is going to be our bond interest expense. This is going to be an interest expense, it's not a payable. Or it's not bond expense. You should mention that it's an interest expense. And so that as a result, our second journal entry will be exactly the same, right? Because any time that we write that, it's going to be the same until we're done with the interest payment. That 3,500 will be paid actually, what the amount of interest expense that we're reporting is more than that because we're calculating based on the discount that was given. And lastly, we're gonna have that bond payable back to, zero. So bond payable is paid out now. And then we have a debit on bond payable, and how do we pay it off? By paying back. And that journal entry will also be always the same as any other method, because that value of the par value of the bond is always what we pay at the end. Okay, any question on this? If you don't have any questions, let me go over the next part, which is going to be our premium. Can you see where no? Should I move? Anyone? Right here? No? Good? Are you still ready? Okay. So next is bond premium. Premium is the opposite of what we had at the discount. In this, we rate on the bond at the time of the sale greater than our market rate. So stated rate is greater than the market rate. Meaning that now, the opposite of the other situation that we had, the seller of those bonds, the issuer of those bonds, now has a chance to receive more money because they're paying more interest, there's more, you know, the market, the investors are, it's going to be more competitive, so investors are more interested to buy those, so they can collect more money than the face value of the, or par value of the bond. Previously, they offered some discount, now they're gonna collect more because they're paying more interest. That stated rate now is 12% and the market rate is 10%. So anytime that you see that the stated rate is greater than the market rate, it means that it's a premium situation. And the other information that is given here, it says that the issue price is 103.6%. 103.6%. Okay, so it means that how much they're currently? 103,600. Okay, instead of 100. So they're collecting more money. So because of that, we say that premium. The opposite of the discount, which we mentioned that was a contra account. This is an adjunct account. So this is going to add to the value of the liability. The liability, an adjunct account for the liability. So the opposite of when we have a contra account. Okay? When we have a contra account, has the opposite value. When we have the adjunct account, it has the same value on the same side. So interest dates are 6/30 and 12/31. One date is December 31st, 2026, and then the maturity date is on 2028. So it means that it's a 2-year bond. They're going to pay interest 4 times. And as a result of that, you see we start with the par value. This time par value was 100,000. However, the cash profit was more than that. So we end up to have some premium. That premium, the opposite of what we did before, as I mentioned, is an adjunct account. You see that the positive side of this premium is on the credit side, so it has the same side as a liability account, so that's why we call that adjunct. So it will be added to the value of that in our balance sheet. Okay, so the bond payable will always remain the same, 100. Okay, so in our example, but now to make this work and to make this balance, we have to have an additional credit account, and that credit account will be a premium on bond payable for the value of 3,600. And that is what we have in our balance sheet. What you see here is the balance sheet presentation for that premium, which we start with the bond payable, which is always going to be there, 100,000 until we pay back. But then we are going to, instead of when we had discount, we said less premium, now is plus premium. Less discount, now is plus premium. And then you see that the carrying value is now more. See that? And the reason, think about it, they collected $103,600 cash, right? So asset total, and so the funds payable would be always 100, and 3,600 is going to be on bond payable, and we calculate that way. And so when we calculate the interest, this is the opposite of what we did on the discount. Each time that we calculate the bond expense, we are going to deduct that premium from the total interest that's paying to calculate the interest expense. So as a result, each time we are reporting less interest expense in our income statement. We're not going to add it up. So you see that premium on bond payable, to amortize it, we need to debit, because when we started, it was a credit, now we are removing that value, so we are debiting that amount for 900. So it's the total opposite of what we did with discount. So similar to what we did there, we have the 6,000, so the calculation of interest will be the same. 4 payments, and then we're going to calculate the each one by multiplying that 100,000 by 4% divided by 2. So it's going to be 6,000 multiplied by 4, 24,000. That will remain the same. Next premium, this time we have that premium taken away to calculate our bond interest expense. Okay, so the total interest expense that we record until we're done with it after 4 times of interest payment will be only 20,400. So the amount of interest payment is going to be more than what we report as interest expense. And the reason for that is that because they're collecting more money, they're calculating that money that was collected, they're kind of calculating it against the interest that they're paying. They're saying that you're paying less interest because you have more money. Right? Got it? Okay. So that is what we have there as the premium. And each time we are doing the same thing, it's depending on the number of periods, we're going to amortize it like that. So this time, you see that we started at 3,600 and we're going to amortize it the same way that we did the discount, with the discount. But however, we're going to have the carrying value, which is bigger than our face value in the premium situation. And then it's going to be lower, lower, lower until we get to the 100,000. So the goal is to get to that 100,000. This time we start with the bigger carrying value. Okay? By amortizing that premium, you're reducing that value. So let's go over an example. It says Mookie Company issues 10% 5-year bond on January 1st of this year with a par value of 200,000 and semi-annual interest payment. Use the straight line bond amortization table to prepare the dormant entries for the following. So the issuance of the bond was for 216,220. Okay, so the par value was 200, but they're receiving more money. So this is a premium situation, and we know that because it says that. Okay? So it's a 10% the interest that they're paying, and so we know the interest rate in the market should be greater than that 10%. It's not even that we know that it should be greater than that. So unamortized part of it is the 16,222, and how did we get it? We deduct the 200 from 216,222 to get that. And then each time we're going to amortize it depending on the number of the times that we were amortizing, we're paying interest. And here we have 5 years, so we're paying interest 10 times. 5 years semi-annually, so divided by 10. So each going to reduce it by 1,000. And so as a result, the cash payment, the first one entry would be the collection of so premium and bond payable. Okay, so each time that you're paying interest, that interest expense now is lower than the cash. So cash is whatever cash is you're calculating here 200,000 multiplied by 10% divided by 2 is going to be 10,000, right? That 10,000 will be greater than the actual interest expense that you're reporting. And the reason for that is that you're going to reduce that based on the premium amortization. So now our premium is amortized by 1,622 each time until we get to 0. And this is going to be the same dormant entry. The next one for December 31st, we're going to have the same thing, right? So we're going to have that repeated for 10 times this time in this example until we can decide it. Any questions? So So as I mentioned, because you know, I hopefully understand the discount situation, this is going to be similar, it's just the opposite. And you start with the bigger carrying value, and then you're gonna lower it down to get to the face value. So as a result, when we pay that back, if I wanted to record the journal entry here to pay that back after 10 years, after 5 years, 10 times, in 5 years, then I'm gonna pay what back? 200,000. No matter what, we're gonna pay the face value of that fund payable. So last journal entry would be fund payable for 200,000 and cash for 200,000. Okay, that would be the last journal entry that we're gonna record. Clear? Okay. So if this is clear, let's move to the next example. And so we have the bond that is issued on January 1st, 2021 with a par value of 400,000. Bond annual contract rate is 13%. Okay, and it says 13%. However, it says the annual market rate is 12%. So we know that this is a premium or discount. The contract rate is greater than the market rate, so it's going to be a premium situation. So as a result, they sold it for 409,850, and the face value of the bond was 400. So we know that the premium amount is 9,850. And for calculation of the interest, we're going to just multiply that 400,000 by 13% divided by 2. Each time they're going to pay the interest of 26,000. We multiply it by 6 to have the total interest. So the total interest payment will be 156,000. However, the total interest expense will be how much? Will be less than that, right? We have to take away the premium. So this time, the total interest recognized over the life of the bond, this is the interest expense that we're reporting, is for 146,150, which is lower than the actual amount of interest payment. You see that, right? And then so we use the straight line method to amortize it. So we start with that 9,850, and because here we have the 3 years, and each year they're going to pay 2 times, so it's going to be a 6 years, 6 time amortization. So we're going to divide that 9,850 by 6. So each time we're going to amortize it for 1,642. Okay, that 1,642 reduction in our premium will also reduce our carrying value. Okay, so our carrying value, we start with the amount that was collected, this amount, and then we're reducing until we get to the face value of the bond. Okay, so that's how we amortize it. So each time that the payment of interest is going to be paid, the interest payment is equal to 26,000, but the amount of interest expense is 26,000 minus 1,640. Correct? And at the very end, when we are done, we're going to retire the fund. So it means that that 400 will be paid. So cash goes down and one payable also goes down. One payable debit and cash debit. Any question on the premium part? Okay. So needed, and we're going to pay back. Retirement of the bond is always going to be the based on whatever it is under the bond payable and the carrying value as well. And here is the carrying value is equal to the bond payable, it's the last day, so we're done there. That is going to be what we have as a journal entry. Okay, and this is just issuer of those bonds can. And that should be on the contract as well. Sometimes they mention that they may just retire the bond like early, right? If they do that, meaning that they don't need that money anymore and they're not gonna pay any more of interest, okay? If that is included in the bond contract, that means that anytime that they don't need that money anymore, they can just pay it back and don't pay any more interest. So it is possible. If that's the case, if there is any remaining value in our premium, if our carrying value is less than or greater than our retirement price, then we end up to have gain or loss. Okay? So in here, what you see here is that before the actual bond is fully amortized, the premium of the bond is fully amortized, what we have is that 4,500, we have to remove it. It was in there too. Okay? It's after a couple of don't want this anymore. They pay you back. That's why we call the retirement before maturity, early retirement. Okay? So in our previous situations, we waited until we amortized. So they paid all the interest and they amortized everything that they had either as a discount or as a premium. And at the end, we had the face value equal to the bond payable. Remember, to the carrying value, 100,000, so that it was easy to remove it. But if we have a situation that they want to do it early, before maturity, if you have a discount, it means that there is some discount still there, right? If it's a premium, it's still, some premium is still in there. In here, it says assume that $100,000 is callable bonds, and we call those callable, it means that those specific bonds, anytime the issuer can call those and then can pay it back, will not to pay any more interest. It means that they have a recourse on. So when we have a callable bond and will be retired on July 1st, after the first interest payment, so they have the first interest payment, and then they are going to say, we're done, we're not gonna pay the remaining interest, we're done, we're gonna pay that money back. The bond carrying value is 104,500. So it means that we have some premium, and that premium, you know that how much is that premium, right? 4,500, you see that there. So that premium is still in there, so we have to remove that premium. That's why we are going to debit that premium for the amount of 4,500, right? Premium at the beginning at a credit balance. Remove it, you have to debit, right? Whenever you see that premium is a benefit, means that you're removing it from them. And then you have, and they say that they're going to, it says the bond had a call premium of 3,000. So when they wanted to pay, they paid 103,000 instead of 100,000. Okay, a little more. Okay, these are based on contract. This is not optional, but it's based on the contract. They had to pay a little more because of the. Then we have the bond payable, remove the bond payable is 100, and then that remaining premium is 4,500. You see that it's not balanced? So if it's on the left side that we have to make it balanced by forcing this 1,500 on the credit side, then that is going to be always a gain. If this was, because this is greater than this, right? If this was more, let's say if this was 107, then we had a loss. Okay? If the cash that was paying to retire those was 107, then we would have a loss of how much? 7,000 minus 4,500. 2,500. You see that the balance now it goes on the left side. You see, it's the 107. The total of it is how much? 104,500. So you have to add something here as a debit. If you add it as a debit, it's going to be a loss. If you add it as a credit, it's going to be a gain. And that loss or gain situation is always in there in accounting, in our journal entries, and there is a sale. Okay, so this is because it's an early bond retirement. You sell any assets, and usually you are not going to collect the same amount as the fair value, so you are going to end up to have some. Yes, you have a question?
So is this going to consciously both of that?
Hmm?
Will you debit and credit not
No, first we need to, basically what we do is that we add these three parts based on the information, and depending on where we need to add that extra, retirement of on the one, the extra difference to equal it out, then that is going to be either a gain or loss. It is, let's you see that it's a credit. But also you can tell the bond payable had 100 value, and then also the premium on it was 4,500, but they're paying only 103, so they have a gain. If they would pay just only, if I change it to, let's change it to this. If I change it to 4,500, then no gain, no loss, right? This would be 104.
What's up with y'all from Cali? Where y'all from?
Right? And this is 104,500, so no gain, no loss. Depending on what you do. Clear? Okay, great. So now let's go ahead and the par value of 10,000. So the call option requires the trader to pay a call premium of 500 plus par. So it will tell you how much they need to pay if they want to call. And that's based on the contract. So if they decide to call, they have to pay 10,500. The bondholder to retire, pay that to the bondholder to retire the bond. On July 1st, trader exercises the call option. The call option is exercised after semi-annual interest is paid the day before on June 30th. Record the entry to retire the bond under each separate situation. First, if the bond had carrying value of 9,000, if the bond had carrying value of 9,000, meaning that we had the bond payable of 10,000, but the bond carrying value was 9,000, meaning that we had a discount. You see that? 9,000 versus 10,000. That means that we had a discount of 1,000. Still remains, okay? So we are retiring it, and we are paying how much? It says that they need to pay 10,500. So that part is given. We're not going to do anything with that. Rather, we're going to say the cash payment is 10,500. So now it's the time to make it balanced. You see that it's not balanced, and you are in this course for more than 13, 14 weeks. So you should know that this is a journal entry, and we have to be balanced. And debit part equal to the credit part. It is not. And how much is the missing part? 500. Where do we need to put it to make it balanced? On the left side. So debit side is going to be a loss. Loss of retirement, out of funds. Okay. Now the second situation. The bond value had a carrying value of 11,000 this time. So our carrying value this time was more than bond payable, meaning that we had a premium of 1,000. Right? Yeah. You see that? relationship. So that one now we have that, and we know that the cash was paid is equal to the previous situation. So the cash paid was 10,500. The call option, that's it. Okay. And the difference this time is going to be a gain because we have to add it in the credit side. You see that there we have 11,000 in the debit side, and the credit side we only have 10,500, so it's going to be a gain. Any questions on that? If you don't have any question, let's quickly go over this last final example, and then we can take your quiz and ready to.
Oh, quiz. I didn't know we had a quiz. This is fucking.
And this is an early retirement situation. So this is the last part that we went over. And so pay attention to that. It's going to be a discount, but it's going to be an early retirement also.
Thank you.
So if you are here and you haven't completed your exam 3 yet, please complete by the end of tonight. This is the due date, so you have to complete your exam. If you have any missing work and you need to talk to me, please send me emails or stuff by my office hours. Yes.
On the example, it says that on January 2021 the bond is issued, but then it says 6 years later on 2026 we retire the bond. So we just change that to 2027 or change it to 5 years.
Not sure what was the question. So it says for 2021.
Yeah, but then it says 6 years later is 2026. Like, would that be 5 years later? Or am I missing?
2, 4, 5, 6. Yeah. Yeah, you're right. Should be
Just make it 5 years?
5 years maybe. Yeah.
Okay, I just want to
Hopefully that would yes, good attention. Thank you for letting me know.
I noticed that. Yeah, I noticed that too, bro.
5 years maybe.
Yeah, noticed that too.
Yeah.
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 Okay, 5 years.
So I'm gonna go started. I don't have time to let you to do it on your own. I'm gonna go over it. Pay attention if you have any questions. We are gonna do it step by step together. So if you have any
This shit
questions,
is horrible.
just raise your hand. So first part of this question says, what is the amount of discount on this bond issuance? And you know that. How much is the discount? Is going to be the difference between what they issued that for and then also the face value of the bond, 700,000, and we have the 684,250. So that is going to be a discount.
That's right.
How much amortization of the discount is recorded from January 1st, 2021 to December 31st, 2025? And that discount will be, original discount was 15,750. So for 15 times, if we do it, and one term was 15 years, right? It says 15 years. So that 15 years will give us the amortization of 1,050 per year, right? It's going to be amortization for a year of 1,050. And then it also asks us to, and it doesn't say it says interest is accounted and paid for through December 31st, 2025. Okay, so they know that they paid the interest. The sale, it would be 6 years. 2020. So maybe just change the first one to January 2020. I think that makes it easier. Another one. No, this is 250. This is incorrect. It's 250. So they amortize it for 6 times. So it means that they amortize it by 6,300 until the December 31st, 2025. I think to make this work, it's better to just change the January 1st to 2020. That makes more sense. So that is going to be what we have as amortization, and then so as a result of that, our carrying value will be the amount that was actually original discount and the amount that was already amortized. So unamortized part of it is still 9,450. So the carrying value at the time of the retirement was 690,550. And the next part of this question is asking us to record either a gain or loss and when the bond is retired. So for the retirement, we know that was a requirement for this retirement to pay 731,500, and that was given. So that amount is paid. However, carrying value, we just calculated that carrying value at 690,550. So as a result, we know that we had a loss of 40,500.
Bless you.
Okay, so the difference between the carrying value and the amount that actually paid to retire that month. So how do we record the journal entry for that? One payable always goes down. So one payable will go down by how much? By 700,000, right? So one payable will always go down by the face value. One payable is going down by 700. And then at the same time, you have a discount that you're taking out. So
All right, talk to y'all later.